Most people think money grows because somebody worked harder. Sometimes that is true, but if you watch long enough, you begin seeing a deeper pattern. Two people can work equally hard for 20 years and still end up in completely different places. One keeps feeling that every step forward is partially erased before it can become strength. The other keeps feeling that once progress begins, the progress has a strange habit of staying. That difference, it is not always discipline either. Very often it is structure. That is the word I want you to keep in your mind. Structure, the financial system, is not random. It has rules. Rules about where money sits. Rules about how long it stays there. Rules about when growth gets taxed. Rules about when value can move without tax. Rules about whether income is treated as labor or ownership. Rules about whether cash arrives as salary, profit, gain, or borrowed liquidity. And because those rules exist, the same $1,000 can live two very different lives depending on the box it enters, the timing of the exit, and the kind of claim it represents along the way. That is what most people never learn. They think money is only about amount. It is also about path. I have always believed that wealth is built in at least two layers. The first layer is effort. You do the work, you save, you resist the ordinary leaks that drain most households. That layer matters. The second layer is systems literacy. You learn how the machine treats different kinds of money differently. You learn that $1 of wages does not travel through the world the same way, $1 of long-term capital gain travels. You learn that an account is not just an account. It is a legal environment. You learn that a business entity is not just paperwork. It is a container that changes exposure, deductions, and compounding. You learn that selling is not the only way to touch value. You learn that delay can be a feature, not a flaw. That second layer is where acceleration begins. And because most people never learn it, they live their whole lives on the income layer alone. They work, they get taxed, they try to save what remains, then they work again, they get taxed again. Then they invest what is left in a plain taxable environment and let more friction chew away at what would otherwise have become larger future capital. This is one reason the wealthy often look like they are playing a different game. In a sense, they are. Not always because they are cheating. Very often because they understand where the legal doors are. The doors are not hidden. They are simply written in language ordinary people do not read until too late. That is what I want to make plain. I do not want to talk to you like a professor. I want to talk to you like a capital allocator. Because money, once it begins to matter, stops being, it becomes stored optionality. And optionality is shaped by rules. Let us begin with the first simple but powerful idea. The box matters. Most people look at an investment and ask only one question: what is the return? That is not enough. I want another question immediately behind it. Inside what box does the return happen? That question can be worth more than the difference between a mediocre investment, same amount, same timing, same investment return. The surface story sounds identical. It is not. If one person puts the money into a plain taxable account, that money starts collecting friction immediately. Interest may be taxed, dividends may be taxed, gains may eventually be taxed. Each little bite reduces the future base. And because compounding is sensitive to base, every bite matters more than it first appears. The other person puts the money inside a tax-advantaged account. Now the story changes. Maybe taxes are delayed. Maybe gains are never taxed if the rules are followed. Maybe an employer adds a match on top of the contribution. Now the account is not only earning on the original $1,000, it is earning on a larger untouched base. That difference starts quietly. Then it becomes enormous. People keep wanting bigger investments. Often the first better move is a better box. This is why I tell younger people that one of the simplest guaranteed or nearly guaranteed wins in the whole system is not brilliance in stock picking. It is using the structures already available to you before you try being clever. A match is not glamorous. It is wonderful. And the earlier it arrives, the more useful it becomes, because time compounds not only returns, but initial advantages. I have spent much of my life watching the consequences of small early edges left undisturbed for long periods. That is what a tax-advantaged account plus a match can become. A small edge left alive long enough to become a meaningful difference in a future life. That is the first door. Now let us move to the second. Not all money is taxed the same. This is one of the most important truths, and it is also one of the least emotionally satisfying, because people want the world to be cleaner than it is. They want effort and taxation to line up in some morally tidy way. The system is not moral in that sense. It is structural. Money from labor is usually taxed as it arrives. You work, you earn, tax comes out. Only what remains can be saved or invested. Money from appreciating assets behaves differently. If an asset rises in value and you do not sell it, the gain often just sits there untouched. Growing, no tax event yet. That delay is not a detail. That delay is a compounding advantage. And over 20 years, that advantage can become the story. Think of two people building wealth side by side. The first depends only on earned income. Raises come. Good. But every raise is taxed before it enters the investment engine. The second owns assets that appreciate. Stocks, funds, maybe property. The values rise and the gains stay unrealized. No annual tax drag on the appreciation itself. The money compounds on a larger internal base. Years pass. The first person may have worked just as hard or harder. The second may still come out ahead because his compounding happened in a cleaner channel. This is not fantasy. This is mechanics. Earned income is taxed on the way in. Capital gains are taxed later, often at lower rates. That single structural difference explains more than most people realize about how wealth begins pulling away from wages over long periods. It does not mean you should disrespect labor. Labor is the beginning for almost everyone. It means that if you want real acceleration, some part of your life must eventually move from labor into ownership. That is when the machine changes gears. This is why I often tell people not to aim only for a bigger paycheck. Aim for a bigger claim. A paycheck helps. A claim compounds. The paycheck is excellent for living and saving. The claim is where time begins doing some of the lifting beside you. Once you understand that, another idea that sounds exotic suddenly becomes much simpler. Buy, borrow, die. People hear that phrase and imagine some aristocratic trick they were never meant to understand. At its center, the logic is extremely plain. Most people think the only way to use the value of an asset is to sell it. That is one path. It is not the only one. If an asset has risen significantly in value, selling can create a taxable event. That may be fine. Sometimes selling is correct. But there is another path. You may be able to borrow against the asset instead. Now the asset stays in place. It may keep compounding. You get liquidity. And because a loan is not usually treated as realized income, no sale, triggered tax event occurs in that moment. That is a huge distinction. It does not make borrowing magical. It does not make it free. Loans must be serviced. Collateral can fail. Structures can be abused. I am not selling fantasy. I am pointing to a rule. Value does not always need to be liquidated to become usable. That is the rule at the ordinary level. People already understand versions of this without using lofty language. A home equity line, a securities-backed line, a business credit facility against assets. The logic is the same. Do not destroy the base if you can unlock liquidity without doing so. That is exactly the kind of contrast people need to understand. Because once you see it, you stop thinking in such primitive terms. You stop saying, I have value, but it is trapped unless I sell. No, sometimes the value can stay where it is and still support your next move. This matters because selling stops compounding on what you sold. Borrowing may preserve it. That is a very different long-term outcome. And if you combine that insight with a strong underlying asset, then you begin understanding why certain people appear to live so differently from high-income workers who keep liquidating everything each time life requires cash. This is not because workers are foolish. It is because they live mainly on the realized side of the system. The asset owner, when disciplined, can sometimes live on the collateral side of the system instead. That is a different form of optionality. Now let us move to another part of the structure that people misunderstand emotionally. Depreciation. This is a beautiful example of how the tax code can describe the world one way on paper, while the world behaves differently in reality. A building may be producing rent. The land under it may be growing in value. The neighborhood may be strengthening. And yet, for tax purposes, the structure itself may be treated as if it is wearing out a little each year. That is depreciation. On paper, a portion of value is being consumed. In reality, the property may be sending cash to the owner every month and still rising in market value. That gap between paper wear and real cash flow is one of the most powerful structural features in real estate, because now two things can be true at once. The property is actually generating money. The taxable income appears smaller because depreciation reduces it. That matters enormously. Real cash can be coming in while taxable income looks much lower on paper, sometimes even low enough that a profitable property appears almost profitless for tax purposes. That is not a trick in the illegal sense. It is an incentive. The system wants buildings built, maintained, rented, and held. So it gives the owner a more favorable treatment than a simple wage earner would receive on the same cash flow. This is one reason so many people discover, usually late, that the world is not divided only between workers and investors. It is also divided between those who understand which kinds of assets the code likes and those who do not. Real estate has long been one of the code's favorites. Not because every property is wise, not because every landlord is a genius, because the structure itself was designed with incentives around it. And once you understand that, another part of the machine becomes easier to see. The compensation you receive from an employer is not just salary. This is another place ordinary people leave money lying around because they keep looking only at what is obvious. The paycheck hits. Good. That is visible. But the better question is what else arrived with the paycheck that does not behave like ordinary taxable cash. Employer stock purchase plans, contribution matches, equity grants, health structures with tax preferences, savings accounts with tax preferences. These are not small side bonuses in the conceptual sense. They are structural advantages. If two people have the same salary but one roots part of that compensation through matched contributions, discounted stock purchase programs, or tax-favored health and saving structures, the second person starts with more effective capital. Not because he is smarter, because he used the machine more completely. This matters especially early in a career. Early career money often looks too small to deserve careful structure in the eyes of young workers. That is a huge mistake. Early is when structure matters most because time is still abundant enough for small percentage differences to become major later differences. The public keeps waiting for the big money before it starts behaving intelligently. I prefer the opposite. Use the structure early. Let time amplify it. And when the employer match appears, take it seriously, because that is one of the few times in life when the system hands you an almost absurdly favorable starting line, and most people still treat it like paperwork. Now let us shift from money boxes to geography, because location is one of the quietest multipliers in the whole equation. Where you earn and where you spend do not always need to be the same place. That sounds obvious after the remote work era, but people still fail to appreciate how powerful the difference can be. One salary can feel tight in one city and abundant in another. The person did not get smarter. The system around the spending changed, rent changed, transport changed, service costs changed, lifestyle pressure changed. The gap between income and cost of living widened. And once the gap widens, saving and investing stop feeling like fantasy. This is one of the most powerful forms of legal wealth acceleration available to ordinary people. Not because it is glamorous, because it is direct. You can spend years chasing higher income while ignoring the fact that your environment is swallowing most of the gain before it can become capital. Or you can keep a decent income and reduce the burn rate enough that ownership begins compounding much sooner. Income can travel now in ways it often could not before. And when it does, breathing room appears. I like that phrase, breathing room. Because wealth is often born not in dramatic jumps, but in the first consistent appearance of breathing room. Once breathing room exists, the next good habit can survive long enough to matter without it. Every good habit gets interrupted by ordinary life. Now, let us go back into structure again, because once a person begins earning through something other than standard employment, the path of the money changes. And when the path changes, taxes change. This is another place where people remain childish. They think money is money. No, money is also a route. If money comes to you as personal wage income, many expenses happen after tax. You earn, taxes come out, then you spend what remains. If money flows through a legitimate business, many expenses tied directly to producing that income happen before tax software tools. Education connected to the work, travel tied to the work, professional services, equipment. The point is not that everything becomes deductible. The point is that value-producing costs are treated differently from ordinary personal consumption. That changes the base on which taxes are calculated. Small operations like consulting, freelancing, side projects, online income, and contract work already enter this logic. Once income is treated as business revenue rather than ordinary salary, that is not an invitation to nonsense. It is an invitation to seriousness. If you are creating real value through a business channel, then the system often allows the costs of creating that value to reduce taxable income before tax is assessed. That means more money remains inside the machine. More money inside the machine means more reinvestment. More reinvestment means a stronger future base. Again, same, very different path. This is what I mean when I say most people live only on the income layer. They never develop structural literacy. They never ask whether the path itself is costing them compounding. And then there is turnover. How often money moves may matter almost as much as where it sits. This is why index funds remain such a powerful answer. Active trading looks intelligent. The public is too easily seduced by movement. Buy, sell, rotate, optimize, harvest, switch, react. All of that feels like financial seriousness. Very often it is simply friction. Every time an investment is sold, a taxable event may be created. Every taxable event takes a bite out of capital. Every bite reduces the future base. And because compounding is sensitive to base, every repeated bite matters more than the trader likes to admit. An index fund, particularly one with low turnover, often lets much more of the growth remain unrealized and therefore untaxed for longer inside the structure. That is one reason indexing is not merely low cost. It is often tax efficient by design relative to active strategies that realize gains constantly. The system quietly rewards capital that stays put. That sentence is worth remembering. The system quietly rewards capital that stays put. This is one reason patience looks so unimpressive at first and so magnificent 20 years later. The patient person is not only receiving market return, he is also often receiving lower friction around the realization of those returns. The active trader may feel like a genius 3 times a month and still end up behind because the structure kept leaking. Now, once wealth begins to accumulate, a new question appears. How do you keep one area of life from spilling into all the others? The public often speaks about asset protection in a suspicious tone, as though any attempt to separate ownership from exposure must be some sort of moral trick. That is childish. An economy that wants people to build things, invest, own, and take reasonable risks must also offer legal structures that stop every risk from contaminating every asset. That is what wrappers do. Companies holding entities, defined ownership structures, they create boundaries. Business risk stays in one container, personal life stays in another. A property sits in a wrapper that is not simply your name, that is not hiding, that is architecture. Ownership and exposure do not have to be the same thing. That sentence is far more important than most people realize. If you hold everything personally and directly, then one lawsuit, one dispute, one accident, or one bad business episode may try to reach far more of your life than it should. A structure creates walls. Walls matter. I have always admired intelligent walls. And finally, we come to the simplest and most powerful advantage of all. Timing. Taxes on gains usually happen when gains are realized, not when they merely exist on paper. That creates one of the most underrated freedoms in the whole system. The freedom to choose when realization happens. Salary offers no such freedom you earn. It is taxed. Immediately, an appreciated asset can sit there for years while a tax event is deferred. That delay means more money remains invested. A larger base continues growing. More growth occurs before the system takes its share. That is not a small thing. That is one of the central levers of wealth. This is why patience is not merely a virtue in investing. It is often a tax strategy. Do not misunderstand me. I am not saying never sell. I am saying understand what selling means beyond the psychological feeling of action. Selling is not only portfolio movement, it is often a tax event. And if the asset is still good, if the thesis is still strong, if the need for liquidity is not real, then mindless realization may simply be volunteering for friction before it was necessary. This is why I think the entire money game can be described through 4 levers: location, where the money sits, timing, how long it stays untouched, and when realization happens. Ownership, whether you live only on the labor side or begin accumulating claims on assets. Structure, the legal and tax path the money travels through. Most people spend their whole lives paying attention only to how much did I earn? How much did I save? How much did I invest? Fine, those matter. But if you ignore location, timing, ownership, and structure, you will work harder than necessary for results that still feel strangely thin, and that is what breaks many people emotionally. They are not lazy. They are simply running too much of life through the highest friction channels. Then they look at someone else and say that person must be lucky. Sometimes the person is lucky. More often the person simply understood the machine earlier. That is what I want for you. Not cynicism, not obsession. Understanding, because once you understand that the system is rule-based, not random, you stop arguing with reality emotionally and start using reality intelligently. You stop asking only, how do I make more? You also ask, where should it live? How long can it stay? Can I shift part of my life from labor into ownership? What structure best protects and compounds it? Those are much better questions, and good questions compound too. They compound into stronger accounts, cleaner balance sheets, lower friction, better sleep, more optionality. Eventually they compound into something calm. The calm that comes from understanding why your capital behaves the way it does. The calm that comes from knowing which levers are legal, available, and worth using. The calm that comes from realizing the wealthy are not always playing a secret game. Very often they are simply playing the visible game with more structural awareness than everyone else. That awareness is learnable. It changes everything, not in one glorious cinematic moment, in the quieter way that good systems always do. It changes how fast the snowball keeps more of itself while rolling downhill. That is what wealth really is. Not only how much snow you gathered, how little was lost on the way down.